Hey everyone, Travis the Stock Geek here, and today's top investing headline is that famous investor Michael Burry and his firm Scion Asset Management are betting against US stocks in a big way. Some investors are even calling this the Big Short 2.0. Michael Burry, the famous investor, of course, was short US housing in 2007 and 2008. He was ultimately proven right, and they made a movie about him called The Big Short. And now he's getting bearish US stocks, but there's been a lot of misreporting on this topic. So I wanted to help separate fact from fiction and dive a little deeper. So let's just look at the headlines from today. Michael Burry's Scion shorts the stock market in Q2, and you'll see that it reports that the firm bought $890 million worth of SPY puts, SPY of course being the ETF that tracks the S&P 500. And he also apparently bought $740 million of QQQ puts, according to this headline. Other big Twitter accounts like Unusual Whales reporting that he spent $1.6 billion total on put options, essentially using options to bet against these ETFs, to bet that US stocks will go down. However, this is incorrect reporting. This is very bad reporting, and this is from accounts that should know better, but apparently they missed the fact that the way these filings happen, options are reported very differently from underlying stock. Now, if you look at a 13F filing, 13F filings are the filings that are required to be filed with the SEC once a quarter by large investing firms, and they show US stock positions and some options positions at the end of the quarter, but they come out about 45 days after quarter end. So they're a little bit stale. We actually don't know if these positions were changed since the filing came out. We also don't know if there's any offsetting hedges or short positions. But the real big problem is that when you have options positions, it reports the underlying shares of those options contracts and the value of the underlying shares. It doesn't actually tell you what the value of the put options or call options were. And that's a big source of misinformation. So if you look at the 13F filing for Scion Asset Management that just came out literally today, you can see it does show that the SPY puts and the QQQ puts apparently have a market value of almost $1.6 billion. 2 million underlying shares for SPY, 2 million underlying shares for QQQ, and the market value is based on the value of those shares. But here's the thing. Put options and call options, each option contract actually covers 100 shares. And so 4 million shares total would be covered by only about 40,000 options contracts. And we don't know if these options are far out of the money or very deep in the money. We don't know when they expire. They could expire next week or they could expire 2 years from now. We don't know. And that changes the value of those puts and what they cost or the put premium dramatically. So while the underlying shares that would be controlled by these option contracts are reported in the 13F, we don't actually know anything specific about the puts themselves, which would tell us what the market value actually looks like. The market value could be very far off from the market value of the underlying shares. Again, depending on if these options are deep out of the money, if they have a lot of time to expiration or not. So we have a misreported market value here. Now, my estimate is that these 40,000 option contracts probably cost a couple $100 each. He probably went a little bit out of the money, probably gave himself a few months or maybe 6 to 12 months. And so my guess is these option contracts cost anywhere in total between $10 and $50 million. And another sanity check here is to look at how much money Scion Asset Management actually manages. Here's where it also gets interesting. The firm has to file what's called a Form ADV with the SEC once a year. And in Q1, you can see that the Form ADV for Scion Asset Management listed them as having 4 clients and managing about $238 million total of assets under management. That would be all of their assets. So there's no way they could buy $1.6 billion worth of puts if they only managed less than $300 million worth of capital. You can also go back to the previous Q1 13F filing showing their holdings from Q1. The largest stock position at the time was only $11 million worth. And the second largest position was only $10 million worth. If you added up all of the stock positions that Burry's firm held in Q1, it, I believe, would be less than $150 million. So that aligns with what we know with Form ADV, which showed that the firm only manages a couple $100 million. So again, it's kind of a sanity check to understand that while the underlying shares of the options contracts suggest that the value of the bet could be very large, billions of dollars, the amount paid for the actual puts themselves is just a tiny fraction of that. And it would be insane for any firm to bet 90+% of their assets under management on puts that could expire worthless. So that's another clue there. So I went ahead and replied to some of these tweets on Twitter on my handle StockGeekTV. Said Michael Burry did not spend $1.6 billion on put option premium. That's only the value of the notional underlying shares. We actually know very little about how much he spent on the puts, but probably they cost a few $1 million, maybe $10 million. So that's my guess. We don't know. We probably won't know unless Michael Burry wants to make it more public. But 13Fs can be an interesting source of investing ideas. We'll know later this week what Berkshire Hathaway's moves look like last quarter. We'll know some of the other famous hedge fund managers, whether you follow Bill Ackman or David Einhorn or Daniel Loeb or people like that. We can get somewhat of a look into some of their US stock holdings, and that can be interesting. But don't always believe what you see initially from accounts that are farming for engagement or these YouTube wannabe investing gurus. I know they'll be out there with their stupid thumbnails. Oh my God, Burry, Big Short 2.0. Do this now, right? Well, hopefully if you're following StockGeekTV, you know better, and we're gonna try to do right by you and separate the fact from the fiction and just frankly try to bring facts to the investing process and leave the emotion out of it. But until next time, everyone, I hope you have a great rest of your day, and I'll see you soon. Cheers.